Building a monthly paycheck portfolio for retirement. How easy is it? How hard will it be? We're going to go through each and every step of it. Hey everyone, welcome back to the channel. I'm Doug, the retirement guy, and today we're kind of helping people out with showing you how to build a monthly paycheck portfolio that would be strong enough for retirement. We're going to show you some of the funds to use, some of the ways to structure it, to give you some ideas of how to build a long-term portfolio that pays you out monthly by a paycheck and not have to sell shares. Let's get into today's video. Now, before we dig any deeper, we have to do the disclaimer, and that is past performances do not guarantee future results. This information is provided for educational and informational purposes. If you need financial advice, always contact a professional. Let me just start off with explaining one thing to people. Most investors are obsessed with finding the perfect monthly income ETF. And in the search is the wrong goal. They do what we call yield chasing. They're looking for that perfect ETF that pays the largest yields and pays the largest income and that can live off of this one fund. Well, and that's where it starts the problem. As most investors are so obsessed in finding that perfect monthly income ETF that they're searching for that wrong goal of basically that yield. One ETF can fail in the wrong market, but a system of diversified income sources is necessary for long-term survival. What you actually want is a system that is diversified income, controlled risk, and growth to outpace inflation. So we're not going to tell you buy this one ETF or do this or do that. You got to build what we call a complete system to live long term, to have that monthly paycheck. So we're going to introduce you to the 3-layer paycheck system. It's a framework for a total portfolio health. It starts off with the first one, the growth engine. Now I know a lot of you are going to say growth. I've been growing for how many years? I've been putting money away for the future. Every fund has to have a growth portion of it. Number 2 is going to be a dividend stability. We want to make for a smoother ride through retirement. And number 3, which is normally the one that everyone goes after, the income layer. They want the cash flow. Let me explain quickly each one. The growth engine, it's that portfolio expansion. It's a broad index exposure like using QQQ or VOO, which is the S&P 500 and NASDAQ 100, to ensure your portfolio outpaces inflation over long term. That's why you need growth. We want to continue to fight inflation for as long as you have the portfolio. Next, the dividend stability is for a smoother ride. We're going to invest into quality dividend ETFs, like the Charles Schwab SCHD, and to provide compounding growth that will reduce the volatility. Compounding growth that will help your income layer, it will help your growth layer. That will help reduce the volatility in the market. So when you're sitting there watching the evening news and you hear them say, oh, the stock market was down today and the S&P hit its rocket low, you have something to help that volatility smooth out your ride. And then number 3 is that income layer, that cash flow. This is the one everyone wants right off the bat. We're going to give you a covered call and option income ETFs like JEPI and JEPQ style to generate income without forcing the sale of funds. We're not going to sit here and invest into, we'll say, Apple stock, and then when you need money, we got to sell off Apple stock at whatever the rate is today. It could be a bad day, but we need the money to make mortgage. The mistake that most people make is building only layer 3. They only build the income layer. They don't build the entire system. That can create income today, but weaken your future long term if you only build one section, one pillar of the system of number 3. It could create a huge problem into the future. Let's talk about number 1, the growth leg engine. 15% of your portfolio. This is my recommendation. Now, this could be different for many different people. I'm going to give you my recommendation. The goal is to ensure your portfolio outpaces inflation over long term. Now, here's what's crazy. I'm going to show you stuff right here. The first fund I tell you that I would put in there would be the Vanguard S&P 500. It's the VOO. The Vanguard S&P 500 is based off the S&P 500 index. The fund is passively managed to hold large cap U.S. stocks selected by the S&P committee. The growth of the fund, 14.05%. The yield is 1.12. So yield is your income. Growth is what your fund, the money you put into it, is going to grow. Now you look at the past performance of this fund. This fund has been well over 10 years already out there. This is the total return. This is something that we also need to talk about. Total returns. Growth is great. Yield is great. But what's the total return? If growth is down and yield is up, the numbers are totally different. So it's always basically growth plus yield equals your total return. So over 1 year, this fund has an average of 15.77% total return. Over 5 years, 14.16, 10 years, 15.70. You can see why we chose VOO, because it's such a stable fund for continuous growth. Now, inflation. What is inflation? 2%? 3%? Well, we just went through some 4% inflation rates. We're giving you something here that will control basically a 14% package. The other one that we use is the Invesco QQQ. Now, this one goes into the NASDAQ 100. Now, this is the heavy tech side of things. Now, we're going to show you the yield, nowhere close, 0.45%. So again, we're not looking for income, we're looking for growth. 17.43% growth. Another long-term fund. 18% over 1 year, 14% over 5 years, 20% over 10 years. Since inception, 11.06%. You see why we put two of these funds together. Over since inception, one's at 14, one's at 11. They're working together in two different segments of the stock market. Okay, they're working differently. They're giving different returns at different times a year. We now have two funds generating. This is why we tell you 15%, basically 7.5% into each one of these of your portfolio. Now the dividend stability leg. This one you're going to say is 10% of your total portfolio goes into these two funds. So again, 5% into each. Now, the goal is to grow your dividend and keep stability for long-term income. Now, we're going to call it, think about this, and this is where people start to get a little confused. Well, is this my income section? No, this is helping do multiple pieces. Remember, this is the one that's going to give you that smooth road ride. The first fund we're going to use is we always call the king of dividends, SCHD. This is the Charles Schwab U.S. Equity ETF. It's an exchange-traded fund that's based on the Dow Jones U.S. Dividend 100 Index, a market cap weighted index of 100 dividend-paying U.S. equities. They have a high criteria for selecting funds. The funds has shown about a 9.59% growth with a 3.44% yield. Now, that's only a part of the story of this one. We could go on and do a video just on SCHD, because when they pick funds, they're looking for growth. They're looking for growth of the yield. And at the same time, they're getting actual added growth. We look at long term. Now, I'll tell you, 1 year, 13.84% total return. 5 years, 10.94. 10 years, 13%. And since inception, 13.01%. This one could almost go into our growth side of it, but because of the extra yield that we're getting out of it, we're using it to help fight with number 1 and number 3. Now, I will give you one more thing to it. Look at what's happening currently. 1 month and year to date. 1 month, it's up 9.94%. Year to date, we're talking we're talking, what, 53 days so far? We're up 11.14%. The fund is just continuously increasing in the market that we're currently in. The next one that we use is iShares Core Dividend Growth, DGRO. Now this one here is the Morningstar US Dividend Growth Index. The fund tracks an index of US stocks that are selected by dividends, dividend growth, and payout ratios, and then weighed into the dividend dollar. Growth, higher yet, 14.24%. Yield, down a little bit, 2% compared to SCHD. You can see we're getting both growth and income from these select funds. We go through it. 1 year, 16.79% total return. We take the 5 year at 12.51, 10 year 14.71, and since inception 12.23. Year to date in 1 month 3.88, and then year to date 4.45. You can see these are solid, hardcore funds that have been paying off and growing at the same time. This is what makes your fund so stability and makes it so comfortable down the road. Now, so far, we've showed you 25% of your portfolio is in 01 and 02 categories. Okay? That means 75% of your funds are going into the one that we all love. And that is going to be your income layer. This is the one that we're going to pay our bills with. This is the one that we're going to pay if we have a mortgage, if you're going to pay your car payment, you're going to pay everything you need to live off of and enjoy your time in retirement. Now, 75% of your portfolio will go into this income layer. Now, we used multiple different ETFs for this process, and there's a reason for each and every one of them. Okay? Nowhere did we go chasing yields. I always say that to people. We're not looking to chase yields. We're looking for total returns. We're looking for everything across the board for total returns. Okay, now our focus on this one's going to be closer more to the yield, but we need to have positive total returns. So JEPI, 25% of your fund will go into JEPI with an 8.13% income because it's stability focused on income. The next one will be into JEPQ, 25% into that. That's the growth tilted income that they put more focus on growth. That's why you can see the yield higher, 10.47. Our next one, XYLD. This one's going to put us into a broader market, okay, at 10.46% yield. Now we get into the S&P 500 with the SPYI, the tax advantage income. That's a whole nother video subject we can get into again, tax advantage of the funds. QQQI is the NASDAQ version of SPYI, which is the S&P 500 version. Both of them work heavily in the tax advantage side of it. That 60% of your income is based off of what they call long-term capital gains. So basically you pay the lowest amount of taxes possible using these type of packages. 11.71 and 13.93% respectively. Next, we'll go into IWMI. What is that one? That's another tax advantage income strategy, 13.53% yield, and that works off the Russell 2000. And then our final one is the broad market income DYLG at 10% for a 9.61%. When we get all done with this, we have a 9.57% income average and a total return average of 10.17%. Now, this is what gets into it. This is a diversify the engine. Not everything should be in the same strategy or in the same category. By blending defensive equities, NASDAQ volatility, and broad market calls, you create a more resilient monthly paycheck. Now, section 3, income layer. This is where 75% of your portfolio is going to go to work for you. Now, these percentages and these weights can all change basically off of what your requirement needs are. So you should always know how much money you need to live off of. What's your long-term cost of living? But I give you a real quick sample here. If you weighted it 25% for the first fund, JEPI, JEPI. It's a stability-focused income ETF. Pays about 8.13% in yield. Now, 25% of the fund would go into JEPQ, the growth tilted income, at 10.47% yield. Now, I'm not going to break down each and every one of these into showing you the background and everything to it, because we've done a video virtually on every one of these funds already. But I wanted to show you how these funds all work well together. XYLD, it's a broad market income fund paying out 10.46%. Then we go into the tax advantage income ETFs, SPYI from NEOS, QQQI, again another NEOS, and IWMI from NEOS. All three of these work with a tax advantage system that 60% of the dividend paying out is based off of long-term capital gains. So that gives the longest possible and the lowest rate that you can get in paying on taxes. So they work to try to help cover the cost of the burden of the tax side of things. Now the SPYI is based off of the S&P 500, QQQI is based off the NASDAQ 100, and IWMI is based off of the Russell 2000. Now you look at these, 11.71, 13.93, 13.53%. And then our final fund that 10% goes into is DYLG, the broad market income of 9.61%. This setup gives you a 9.57% income average yield. Now, again, these numbers will change. The minute I post this, these numbers will all change because the yields are constantly changing. Now, you may change your weight limits around to balance more. Maybe you need a little higher income, so you're going to put a little more into the SPYI and the QQQI versus the JP Morgan products. But this is just the basic system to show you. Now, I go back and always remind you, total returns tell the big story. And you can see right now, SPYI, QQQI, and IWMI are all the biggest powerhouses when it comes to total returns. While you're getting other ones are giving you stability, a long-term stability, but they're all close into that 10% total return average. So in summary, let's go back. Growth engine, 15% growth, basically 0.79% yield. The dividend stability, 11% growth to a 2.72% yield. And then the third layer, 0.60% growth. You can see how this whole thing switched to 9.57% yield off of our scenario, which is, like I said, always subject to change. But it's balanced for each category, and there's a reason for each one. Growth, as I told you, was trying to help do it over the inflation. The dividend stability is to smooth out the road. So if we need more growth to help cover the inflation side of things, we have it. If we need growth or income for the income layer to help smooth out the road, it's not going to give us all of our needs, but it's going to smooth things out. We have it to help work into the income layer. Same thing with growth. If inflation stayed right around a 3% level, we have additional growth money to expend into income. This is what we call rebalancing at the end of every year. So now we give you a little example of what this all means. How does this all work about and giving us that target that we're looking for? Let's just start off with, and we're going to use that. This is all hypothetical. This is all just working off of numbers, basic math. If you had $250,000 saved away as your initial portfolio starts off with, you'd have a monthly income about $1,600, a yearly income about $19,200 a year, and you'd have an estimated growth of about $10,000. So your fund would slowly be growing each and every year, basing it off of what inflation will work towards. Now, if you have $500,000 invested, you're going to virtually double what you're looking at. $3,200 a month income, $38,000 a year, $20,000 in additional yearly growth. Now, the magic number everyone talks about is that $1 million mark. So if you have $1 million in investment capital, you'd be collecting about $6,400 a year, or excuse me, $6,400 a month, $76,000 a year, but you're going to be growing at over $40,000 a year. This is why I always come back and say this is when we start doing the rebalancing. How much money did we need in the growth? How much money did we need in our income side of it? And we adjust accordingly. As the capital grows, maintaining the three-layer balance is critical to protect the principal while extracting sustainable cash flow. So everything works with it. And I love the picture down below. And some people will tell me as well, it's a weird picture, different picture. But it actually is really what the path is all about. What is your target? What is your real target? And that is, what is your cost of living? What's your cost of retirement living? So what does it really cost you to have the house, the car, your groceries, the electric bill, the gas bill, all those things all combined together? That's your cost of living. And then in retirement, what's your retirement cost of living? Are you going to want to be like myself that's doing cruises on a regular basis? Or are you going to be wanting to play golf every week? If you want to do different things, what's your cost of total living in retirement? You calculate those out, and that's your target you're shooting for. That tells you in this system how much investment capital that you needed to. And you can dial this all the way down to starting in reverse or starting at the front. It comes down to it. Everything shoots for a target from where you're standing at. So the monthly budget volatility, this is one of the things I'm going to add to this mix. It's kind of like more excitement of you built this paycheck and everything's great and everything worked out well. You hit your numbers and you're working through it. But what else do you do? How else do I plan for this? And what I always call is you plan for the worst month. And that's what I call my worst month rule. Investors don't budget off of their best month. They budget off their worst reasonable month to ensure financial security. So if your income layers pays $3,300 a month, you budget for $27. If you're surplus management, you treat everything above your base budget as bonus for reinvestment or for luxury. Okay, and then the volatility shield. The approach keeps you safe when the market conditions cause distributions to dip. So what does it all mean on that? Well, we went through this one. I did this personally with my wife and said, look, I'm going to collect, and these are the reasons why I put these numbers on there. I said, we're going to collect $3,300 a month. But we're going to budget and live off of $2,700 a month. And why am I doing that? Because if for 1 month, one of the funds has a drop off, I'm just going to say the S&P 500 drops down dramatically and we don't get the dividends that we were expecting that month. Well, it's okay because we have time to recover. We have all the other pillars to work from, but we're only budgeting for $2,700. Okay? So we don't have to always work towards that goal. And then we start putting surplus away, which everyone always says is my emergency fund. But inside of the fund, we have a surplus management that we're slowly putting money away. That's what that growth section does for us. That's why I told you about rebalancing. We're taking that surplus and we're putting it off on the side so that we can buy when the market's either down or buy when we need to rebalance to increase our income. And then volatility. You know, if the markets take a little bit of a dip, like on April 2nd, who knew we would have a major drop off on majority of the funds? Well, two things happened at that time for me personally. Yes, income come down. I didn't panic. While other people were panicking and selling, I turned around and I was buying. It was like going to the mall when my wife always says, I bought this and it was on sale. Oh, I bought stocks when they were on sale. I bought ETFs when they were on sale. And now that they've recovered back up to where they were before, I'm looking like a hero. And it helped increase all my other levels. That's what a volatility shield is. It keeps you safe when market conditions cause distributions to dip. And if you have a surplus, you're able to buy those dips to help increase your long-term stability. The reality check and the retirement check, stable income. Okay? You want to make sure you're buying in the funds that have consistent cash flow to cover essential living expenses without forcing to sell the assets. That's the biggest thing. You want capital stability. You want to protect your principal by avoiding sequence of returns, risk during downward markets. I would hate to see someone invest into a fund and then all of a sudden they need more capital, they need more money, and they got to sell their funds at downturns. And then you also want to make sure you have that inflation survival, ensuring your monthly paycheck maintains its real world purchasing power over decades. So every one of these steps builds towards these pieces of the puzzle that we're talking about. So I'm going to give you file 7 rules for winning inside retirement and inside this portfolio. You do not want to look at yield. You want to look at return. Okay? High yield can be deceptive. Always look at total performance of the asset. So total return means everything. Total return matters. Sounds like I'm preaching, but I'm not. Total return matters. If your principal decays, the yield is just returning your own money back to you. It's point blank simple as I can make it. If your total returns are in negatives, you're just giving your money back. Distributions vary. Monthly payouts are not fixed. They do fluctuate with market volatility and strategies. So you need to make sure you're prepared for those adjustments. That's why I told you to under budget. It's a tool, not a lifestyle. High yield is a tool for cash extraction. It's not a replacement for sound investments. We started the show off immediately telling you about that. Okay? We told you about the whole thing. Is you don't go out chasing yield. You don't go out and buy one ETF. I can retire off of one ETF. Even though there's plenty of videos out there saying, oh, you can retire off of one. I personally have done them. But the answer to it is you need to work with a tool. And the high yields are a tool. But it has to have other pieces into it. Layers beat the gambling. A diversified income layer is far more resilient than betting on a single high yield ETF. And then budget for safety. Never build your survival expenses and variable payouts. Always maintain higher margins. And diversify or learn the hard way. Now here's the thing. These weren't just made up rules. I didn't just make them up. I will tell you point blank, I've probably lived off of every one of these rules in the hard times of life, which is what got me into doing this on YouTube. Diversify versus learning the hard way. Concentrating on a single income source eventually leads to significant risk during market shifts. I've been retired for over 10 years. I don't know if I ever told everyone this whole story, but basically I've been retired for 10 years. Talked with a financial advisor when I was 27 years old. He laughed at me when I said I wanted to retire at 55. I actually retired at 50. He told me how much money I had. That's when I laughed at him. Said, I don't even have enough money to make the end of the month, and you want me to put thousands of dollars away? But what I didn't stop, and I went through all the hardships. I went through all the things chasing yields, thinking I was great. I went after buying one stock only. I went to not budgeting. I don't want a budget. Who wants a budget? I went to buying high yields and not thinking about the whole structure. Every one of these things has a reason why I put them out there for you. Is because I lived it, learned it, and made errors and corrected it. To build a system that pays you today protects you for all of tomorrow. So let me know down below, what do you think of the 3-tier system? Let me know where you're at in retirement. I'd love to hear from you. Are you just starting off? Are you deep into it? How did you retire? When did you retire? I'd love to hear from my viewers. And also tell me, hit that like button. If you like this channel, if you like the video I put out, we'll put out more of these because we believe in helping people retire comfortably. Let me know in the comments below. We'd love to have you, and welcome back to the channel. And if you're not a subscriber, please hit that subscribe button. Now, before we dig any deeper, we have to do the disclaimer, and that is past performances do not guarantee future results. This information is provided for educational and informational purposes. If you need financial advice, always contact a professional.